Thank you. Good evening, everybody. Yes, I also spent 10 years as a stockbroker, and don't hold that against me either. I should have asked you how this works, and is it set up to go?
Yeah, just turn it the other way around, I think. No, that's forward. The other one's back.
Oh, well done. Thank you. Okay, lovely. Okay, so tonight, in 20 minutes, I'm just going to take you through a bit of homespun philosophy that we've put together over the years, 15 years of investing as Hyperion. I'm going to just walk you through how we invest in very basic terms, and then we'll talk about some of the stocks we've invested in. And then I'll give you a bit of a view of where we think this market is now and invite questions. But please, if you have questions along the way, just ask them, because I'd rather people got their questions out and didn't wait till the end and then missed out on the opportunity to ask. What are we actually trying to do when we're investing? I put this chart up because a lot of people want to get to here, the point, the desired outcome, but aren't prepared to wait the time to get there. And the whole market has become so short-term focused these days, it's very hard to keep thinking about the long term, and I mean the long term, 5, 10, 15 years, because I mean, that's the right investment horizon when you're investing in Australian equities. So I put that up at the beginning so that everybody can just think about anything I'm talking about tonight is 5, 10, 15 years, not the next year. Because I can guarantee you, I can shed no light on what the market's going to do in the next 6 months. Really nothing at all. That's all sentiment, and I can't forecast whatever event is going to occur out of the blue, which might change things in the next 6 months. But I can assure you there are a couple of things that will make a real difference to what you get out of equities over a 5, 10 or 15 year period. I thought that little cartoon was quite nice. And really, what is the problem? Well, the problem is that if you're going to start investing, you've got to have a very simple philosophy that's easy to apply. Our investment philosophy, even though we manage money for some of the biggest institutions in Australia, is focused on thinking like a mum and dad investor, which we call ourselves. And it's all about buying high quality businesses and then thinking about what you could earn on a term deposit over a 5-year period. Because I mean, there are a lot of people who'll talk to you about beating the index, but really at your stage of life, and I say that to everybody over about the age of 40, it's all about don't lose my capital. And really, if you think about it, it's the fundamental quality of what you invest that will make the difference. You've got to be able to make money in a market, and how do you do that? Well, there are some huge inefficiencies in all markets, and the one we're looking at today, the Australian market. We've found over a very long period of time that the market generally does not know how to value a quality asset. Most of it is very short term. A lot of the brokers are looking for just 6 months. They're looking for the next catalyst that will change a short-term earnings number. They're not really thinking about the long term. And as a result, the whole market doesn't look out 5 years, it looks out 6 months, and it misses the gems that are sitting out there. The second thing is it's very short-term focused in terms of the themes that it follows. Right now we're in earnings season. Guess what everybody's thinking about? Earnings. What's this company earning? What's it reporting? I can tell you in 2 months' time, it'll have forgotten all about them, and there'll be some theme or fad, some connection with the US, the China story, resources. They'll have forgotten about the underlying fundamentals by and large, and they'll be following a theme. But twice a year, the market is forced to come back to the actual numbers. Now, from year to year, that doesn't matter so much to a lot of market participants, but over time, it makes a big difference. And we're going to just explore a bit of that today. We need to focus on outperforming businesses. What do they look like? I mean, this is just simple common sense stuff. You buy quality businesses that are producing quality earnings over time, that those earnings are growing and those earnings turn into dividends. It's a really simple formula, but it's actually hard to apply because you've got to shut out the noise. And when I talk about the noise, I'm talking about 1 year's earnings. You've got to be able to look out a longer period. It's really hard to do. It's one of the things that every investor really finds it hard to do, is to block out the short term. They need high return on equity. I mean, it's amazing if you looked at the Australian market, how many companies have a return on equity, that your investment in the equity of that business, and that return on equity is barely more than the amount you could have earned by putting it in a 100% safe term deposit. And you've got to ask yourself, if you're looking at it that way, why on earth would you invest in a business with return on equity, the return you get for putting your money in the equity, less than a term deposit, given that investing in shares has risk involved in it? That sort of analysis is rarely done by people in the market. Use real definitions of risk. I hate to say this, but a huge proportion of managers are using risk definitions of short-term volatility away from the index. So how much the index varies in short periods of time, how much a fund or a stock varies in short periods of time in price from an underlying index. Meaningless information if you're investing for the long term. The real risk that you as investors need to think about is the fundamental quality of what you're investing in. Here's the point. What happened through the GFC? Everybody had forgotten about the underlying quality of what they were investing in first, and secondly, they'd used too much debt to fund it. We'll talk about that in a second. The second part of understanding risk is not paying too much. These are really simple things that you would apply every day in your normal lives, but a lot of people forget when they're actually doing investment in the market, when they're buying companies. Buy good quality businesses and then don't pay too much for them. They're really simple things, but we're going to expand on that as we go through here. So let's eliminate the low quality companies. What do I mean by low quality companies? I thought I'd do it pictorially. Isn't it amazing that that during the GFC, which has been, it's been a very painful experience for most investors, what did companies have to do during the GFC? Well, a lot of the companies had a lot of debt. And do you know what happens when your equity starts to drop? The share price of the company drops and the debt stays the same. Isn't that amazing? Equity drops, debt stays the same. So suddenly that thing called a debt to equity ratio starts varying very quickly and things get a bit hairy. And guess what happens? The debt holders, whether they be the bank or the bond holders, start saying to the management of the company, there are some things you need to do and we hold all the cards here. The first thing you're going to have to do is go and raise some more equity. And you're going to have to do it right now. Otherwise, we're going to take control. So the management say, all right, we're going to raise equity. So they go back to the market at the lows and raise equity when equity is at a low. It's expensive to go and raise equity at those times. So they dilute existing shareholders. Second thing that happens is that if that doesn't need to happen, and gee, it happened a lot during the GFC, they say to the management, don't do that long-term development you wanted to do because we're not going to fund it anymore. So there's this hidden cost of debt that people don't understand. They think that the debt in a company is the only risk is the interest rate, but actually it controls the whole company. The more debt you have, the more restricted that business is to fulfill its plans over the long term. So the first rule of investing we have is just don't buy businesses with too much debt. It's a simple rule, and you can just do it as a formula. We use interest cover. So how many times coverage of profits do you have of the interest? And the whole idea there is that if the business starts to sag because of economic conditions, there'll be still plenty of cover over the amount of interest they need to repay. The second thing is finding businesses where this doesn't happen. And, of course, I haven't ever been to a stockholders meeting where they've actually lynched the CEO, but gee, I've been to some where they've been close. And why is that? Why is that? Well, look, we look for businesses where they've got a long-term plan, that's part of it, but also they're in a reliable industry. We like steady industries that really don't have too many surprises. Businesses where the management team have been there for quite a while and are highly aligned to what's happening. They have skin in the game. They have long-term remuneration systems that are aligned to the long-term outcomes of the companies. Those sort of longer-term businesses are the ones that we're looking for, where you don't see changing of the guard all the time in the executive team. I mean, the new world has occurred, and that is that if a chief executive doesn't achieve something within about 2 years, literally their head's on the block, and you see this sort of change. I love this cartoon because really this is the reinforcement of what I'm talking about, is that, I really want all these long-term things, but right now I'd like the return. I've only got so many years till I retire. I need 15% per annum for the next 3 years to hit my targets. Well, it just doesn't work that way. If you want to do that, you've got to buy longer term. So what's a quality company? We like businesses that are growing organically. So what does that mean? An organic business for us is one that has a business model and it's rolling out that business model over time and growing the business from within.